Welcome, everybody. Thank you for joining us for the second session in our Angel 101 high-level overview of angel investing. We are doing this in conjunction with launching a new angel activation and education program called Angel Guide. If you are interested in investing in startups, time and or money, come find us. We're going to be going through a 3-week onboarding with David to help you learn the ropes and all of the mechanics. And then we're going to shoot you into a community of founders and investors to collaboratively evaluate deals and start writing checks. We're super excited about it. You can find it at angelinvesting.com, and we'll post about it more as we go through. We did our first Angel Investing 101 session last week, which was great. We got a ton of questions about the numbers that actually go into the equation of becoming a successful angel investor and building a successful angel portfolio. So that is what we'll be focusing on today. Super excited to have David here to go through the topic. And don't worry, we will record this and send it out to you. We will also include a fun spreadsheet to help you get a feel for how these returns work, what the kind of breakdown of exit outcomes looks like, and how the number of startups you invest in changes it. But with that, I will throw it over to David. Thank you all for being here today.
Greetings. Thank you, Peter. Hello, everybody. So, as Peter noted, this is a session all about angel investing and is designed for proto-angels, angels who are thinking about getting into it, who have just started and wondering how this all works, or have been curious about it. So in that sense, if you're a potential angel investor or a current angel investor, this session is for you. If you happen to be an entrepreneur, however, you can sit quietly in the corner and listen over their shoulder and figure out the economics to understand why angels tend to say the things they do and tend to be really nasty and evil about valuations and don't seem to have the killer vision that you do, and so on and so forth. And you'll see at the end of the day, everybody is pretty much a rational person, and there is a reason behind the craziness. So let's jump right into it. And the first question is, angel investing. Duh, what's that? It's individual people writing checks out of their own pockets into really cool startup companies, hoping to make a lot of money. The book I wrote and that we're using as the textbook for our Angel Guide program is Angel Investing, the Gust Guide to Making Money and Having Fun Investing in Startups. So there are two parts to that, right? There's the having fun investing in startups, and investing in startups is a lot of fun, and you really gotta have to have that fun if you're gonna be an angel investor. But deliberately, the first thing there is not having fun and making money, it's making money and having fun. So the first thing and the most important thing about angel investing is making money. It's about making money, and that is a return on your investment. The cash you put in, you hopefully get more cash back. And so when you're talking about making money, you have to look at it in context. And the context that you're looking at it is, what can you get by doing other types of investing, right? Or where can you put your money? If you have money, what do you do with it? And right now, these days, if you put your money in a bank, you can do nothing at all, have it insured by the US federal government, and end up with about 2.5%. Bank rates these days, saving accounts range from less than 1% to 3 or more. But let's say 2.5% is about what you can get in a totally safe bank account doing nothing whatsoever. Unfortunately, that's not quite keeping pace with inflation. And if you want to actually make some money and get ahead of the game, you have to be willing to exchange security for a little bit of risk. And so therefore, the next thing that most people invest their money in is the stock market. The stock market, these are publicly registered stocks. They're publicly traded. You can buy and sell them at any time on the New York Stock Exchange or NASDAQ. These are the big giant companies that you've heard about with enormous valuations. Typically, if you have invested your money in the stock market and keep it there for a long time, you can do a pretty solid 5% return time after time, year after year, taken in the long haul. And that is even if you invested the day before the giant stock market crash. It turns out that over time, it's about 5%. But what if you are a wealthy person, you've got a bunch more cash, you're willing to take more risk? Well, then you can invest in a hedge fund. And a hedge fund is a fund that goes out and buys stocks and trades stocks in the stock market, but it can also bet against some stocks. You've seen meme stocks, the whole thing about GameStop and stuff, where some people were betting for it and some betting against it. So if you can both bet for and against some stocks, you can potentially do even more. So hedge funds vary widely, but the typical return that they target is about 10%. So that's what Bernie Madoff was targeting. How he got there is another story, but roughly 10% is where they're sort of generally aiming. But what if you say, okay, I'll have most of my stuff in these safe things, but I want to have a potential for getting more, so I'm willing to take a little more risk. Well, then you can put some of your money into private equity. And private equity funds aren't just limited to investing in publicly traded companies. They also can invest in privately held companies, finding private companies that nobody else can get into because they make a deal specifically with the owner. And if you invest in a private equity fund that's investing in these privately held companies over the long haul and often bringing investment and money to bear and helping them grow, they capture all that growth, not the public markets. And so you can, reasonably expect to target about a 15% per year return. But what happens if you want more? Give me more risk, more return. Well, in that case, you can put your money into a venture capital fund. And venture capital funds all like to tell you they're going to hit the next Uber, the next Google, and return a gazillion, billion, $1 trillion over there. But they all, at least with some rationality, say we're targeting 20%. Now, in actuality, because this is very risky, most venture funds don't actually hit that, but that's what they say they're going to try and do. And that's what you're betting that they're going to do. And so the top quartile funds do actually get that or more and can be very lucrative investments. So, okay, if with varying degrees of safety and some risk, you can get these kinds of returns by doing literally zero work, letting somebody else do it and give you back 20%, why would you ever want to do this crazy angel thing? Well, first of all, you got to love it. But second of all, a well-managed angel portfolio, if you do it seriously and if you do it right, the typical average professional angel portfolio can return between 25 and 30% on an annualized basis over time. And that's more than all those things put together, and you get to have fun. So what's not to like? Well, what's not to like is it's hair raising, it's very risky, it's very crazy. You can lose all your money and so on and so forth, but you can make it. So there are two big major approaches to angel investing and to investing in early stage companies in general. And those are what are known as the unicorn hunt and Moneyball. And so the unicorn hunt is what venture capitalists do. And there a lot of Silicon Valley angels do. Playing Moneyball, we'll show you in a minute. So if you're talking about the Silicon Valley approach, which is the big, you got to get into Uber, you got to get into Google or Apple or Facebook when they were just starting out over there, right? A unicorn, the term was coined by Eileen Lee a number of years ago, is defined as a company with an exit of over $1 billion. And just to pick a random year, in 2014, there were 3.2 million companies started and 32 unicorn exits, which meant that the odds of your getting a unicorn, if you were investing in every company starting out there, are 1 in 100,000. Not exactly a big odd. However, VCs need unicorns because VCs are setting up in business and they are telling the people who invest in their funds, the limited partners, that they have the secret for picking these amazing things. But it turns out that VCs are really the reason they don't all hit that 20% return is because finding unicorns is very tough. And here are the economics. So Jason M. Lemkin, who was the head of SaaStr and who was an amazing entrepreneur himself, in an answer to a Quora question, gave this really good example as to why VCs must have unicorns or they go home, right? So let's take a typical venture fund, a $200 million venture fund, right? And let's say that on average, it's making a total of 30 investments over its life, including initial investments and then some follow-on rounds, right? The goal for them, they might start out only 20%, but after a couple of rounds in dilution, they typically will end up maybe with 15% of the company. So they'll have 30 investments with about 15% each ownership of a company. Now, their LPs, their investors, are typically looking for a 4x return. Remember, this is over a 10-year time horizon. VC funds are typically a 10-year horizon. And so, therefore, 4x on the whole value of the fund, which is 200 million, is 800 million, right? So therefore, if you figure that that's the total, that would have to be the total value of all the companies in their portfolio, but they only have 15% of each of those companies. So therefore, if you divide the 800 million by 15%, what you end up with is 5.3 billion, which means how are they going to turn that $200 million into 5.3 billion? The only answer is that small $200 million fund has to hit multiple unicorns, not just one, but multiples. That's crazy economics. That's venture economics. And that's why VCs do what they do. But we're not VCs, we're angels. And the odds of us hitting a unicorn are possibly, probably less than they are for those VCs. I will tell you that I have invested in probably 120 companies over my investing portfolio. I've had some great exits, some amazing companies, but I have not yet hit a unicorn, direct investment in a unicorn, my first try. So therefore, what everybody else who's not a VC or in the Valley does is what I call the everyone else approach, or the Moneyball approach. And this is based not on having the ability to find these mythical unicorns. It's based on finding gazelles. Gazelles are a term coined by David Birch, and it's a much easier definition to hit. This is a high growth company whose revenues are increasing at least 20% a year for 4 years or more after they hit $1 million. So a company going from 100,000 to 200,000 doesn't count. We're talking about once you actually hit $1 million in real revenue and you're growing at 20% a year after that, that's a unicorn. And in the same year that there were only 32, that's a gazelle rather, that there were same year that there were 32 unicorn exits, there were 150,000 gazelles. So that means it's a whole hell of a lot easier and more rational to hit a gazelle, which is still in the top 2% of all businesses, accounting for 90% of all growth out there. So figuring that we're aiming as an angel investor at a gazelle, let's go through how the economics work from an angel perspective. And this is what I call the secret economics of the angels, because if you're not one of these, you will never figure this one out. But now I'm going to pull back the curtain and reveal all the secret sauce. So let's say that you are a typical angel investor. You are what I would consider a rich-ish person. If you're a very rich person, if you're a Jeff Bezos or an Elon Musk, you're not dorking around with angel investing because you have to put out bigger chunks of your cash to get a return. Instead, you have, let's say maybe that you have a $10 million net worth, right? Well, you never want to invest in really risky stuff, a whole lot of your net worth. So let's say that you're going to invest 10%, a maximum of 10% of your investable assets into this angel crazy stuff, right? So that means you have $1 million that you're going to invest in these angel investments. And as we have talked about before, you don't want to put all your eggs in one basket. Did I mention this is very, very risky? So instead, you're going to spread it out. And you have $1 million. So let's say you spread that out over 10 deals. That's a little smaller than your portfolio should be if you do it correctly, but it helps for ease of figuring. So let's say you've distributed your $1 million over 10 deals. And now what kind of return are you looking for? Well, let's say you'd be very happy getting that 25% that I mentioned before, which is what a serious angel portfolio can often return. So you'll say, okay, if I can get 25% a year, that's great. And over how long should I get that? Well, venture funds typically, when they make an investment in a company, a venture fund is typically 10 years. They'll invest 5 years in as they make their investments and 5 years out as they harvest and get their exits. So they're typically about a 5-year hold. So let's say that we are angels. We're coming in before VCs do. So we'll say add another year on that. So let's say 6 years. And so therefore, let's say that I'm trying to get that 25% annualized return for 6 years before there's an exit. So you may remember from your high school math that taking something up at 25% a year, you're taking it to the 6th power, right? So every year you have to have the value of your portfolio being 1.25% as it was the year before. So therefore, if you put in that $1 million the first year, by the end of the first year, you should have $1.25 million if it's growing at 25%, right? But then when you start the next year, you're starting with $1.25 million, and you have to do 1.25 times that. And ultimately it grows. So it turns out that if you do the math, that 1.25 to the 6th power, 25% annualized return for 6 years means at the end of the day, you have to get back 3.8 times the money you put in. That's close to the 4x that LPs are looking at for venture funds. But let's say 3.8x for ease of figuring, and that is your ROI, your return on investment. So therefore, at the end of your angel investing period, you want to get back $3.8 million. And that ends up being worth the 25% annualized return you had. So now we do the math. Actually, it's not that complicated, and we're not doing that math. What we're doing is the reality testing math, because what happens to those typical 10 companies in a typical well-managed angel portfolio? Well, it turns out that no matter how smart you are and how good the companies are and how good the entrepreneurs are and what they're trying to do, out of those 10 companies, 5 of them are going to fail. And when I say fail, I don't mean not just not do very well. You're going to fail completely. All your money is going to be lost. You will get a zero return out of those 5 companies. But luckily, since you invested in 10 companies, you got 5 more shots on goal, right? So of those remaining 5, typically, if you look at the averages, 2 of them are going to be sold. They're going to have some exit, right? It's going to be an acqui-hire where some other company buys the company just to get their employees, or somebody will buy their inventory or their products or whatever, and you'll get back just the money you put in. Okay, it's better than I'm poking the eye with a sharp stick, but it's still not making you any money, right? But luckily, you got 3 more shots on goal. So what happens to those? Well, typically, 2 of them are going to be successes, really good successes that you'd be happy to have any day of the week, right? They're going to return 2 to 3 times your money. If you put in $1 million, you'll get back $2 or $3 million, and that's really pretty good. I would love that all day long, right? But that accounts for 5, 2, 2, 9 out of the 10. So now let's see at the end of this, let's say we've gotten exits now from 9 out of our 10, and let's go back to our math and see what happens. Well, 5 of them, I got back 0. 2 of them, I got back the 1x money I put in, and 2 of them I made money. Let's say the higher end, let's say I made 3 times my money. So what does that mean? Well, remember that each of these accounted for 1/10 of my portfolio, right? So I put in $1 million distributed over 10 deals. So each of these deals was only 100,000. So multiply it out times 1/10, and you'll see that of that return, the 5 times 0 is 0. The 2 times 1 times 1/10 is 0.2, and the 2 times 3, which is great, times 1/10 is 0.6. So I'm still trying to get to 3.8, right? Well, let's take the 3.8 and add up all those other things and subtract it out. That means I've now seen 9 out of my 10 companies have exits, and I got a bit of a hole in my portfolio of 3 times. Well, you say, well, that last one can do 3 times. No, not that last one can do 3 times. I've got a hole of 3 times my whole portfolio. So that means because each company accounts for only 1/10 of my portfolio, that one last deal I have, if that's going to give me the 3.0 to make up my return, that last one deal must return 30 times my investment. 30 times my investment. That's a lot of money. So what does that mean? How do I figure out what I get back for my investment? Well, it turns out that I get back money in my investment because the company has gotten bigger and grown. And therefore, the amount that I get back is, how do I get to that 30 times, is a function of another math function, right? It's taking the exit valuation, which is how much the company sells for, and then you divide it by the entry valuation, how much the company was worth when I invested. And that is what gives me the return on investment, right, that I'm making. So therefore, if we say that as an angel, remember my target for these things is 30x, right? So therefore, how do I get to a 30x return on my investment if it's the exit minus the entry? Well, you've seen all these various charts saying the typical seed round these days, which is where angels will come in, might be valuing a company at $10 million, right? I invested at a $10 million company. Pre or post for this instant doesn't matter. Let's say it was post. So therefore, the company was worth $9 million coming in. I put in $1 million, or angels put in $1 million. It's worth $10 million afterwards. So in order to get that 30x return on my $10 million valuation that I gave to that company, it means that within 6 years, that angel-backed company must have an exit at $300 million. Think about that. What we're saying is when I'm investing at this little startup at a 10 million valuation, I am expecting that within 6 years, it's going to exit at a $300 million valuation. And how often do you think that happens? The answer is not very much. Here is a chart actually showing, this is a logarithmic scale, by the way, it's showing the returns versus how much the company has raised. And if you take a look at where all of these are clustered in the middle there, right? And you take a look at the y-axis on the left-hand side over there at 100 million, right? You will see that acquisitions of VC companies are a little more than 100 million, right? There may be 150 million. I think 145, 150 million, maybe going up a little bit these days, is about the typical VC exit. There are those outliers up at the top, and that's where they make all their money, right? But the typical one, when it exits, and these are the ones that haven't failed, right, is about 150. But look at the thing, the all acquisitions line below that. That's non-VC, that's VC plus the others. And the others, of course, are angel acquisitions. Now, what do you think that number is? Oh, that number looks a whole lot closer to $60 million than it does to $150 million, right? So if that's what the numbers typically show, let's go back and revisit our calculation, right? It's exit value divided by entry value equals 30x. And so therefore, if the exit value is typical for these angel-backed companies at 60 million, what does that mean? That means that our entry-level valuation needs to be about $2 million. And so therefore, all you entrepreneurs in the audience, when your evil angel comes back and says, oh, I'll invest money at a 2 million valuation, and you think that they are a complete idiot and so on and so forth, what they are doing is saying, do I think that this company can get to at least a $60 million exit with 6 years? And that's why angel investors are so much lower on the valuation side than founders would like them to be, because angels are thinking about their entire portfolio, and they understand just how risky that whole portfolio is, and they know what the numbers are. So that then brings us to the risk versus rewards cycle, and looking at various companies and seeing where various company rounds are, right? So whenever you have a bunch of people or one large investor investing money into a company at a certain valuation at a certain time, more or less, say within 3 to 6 months, that's called a round, right? And the first round of investment of putting in money for equity in a company comes from the founder. Right. So the founder puts their cash in, and, angels, I will tell you that if the founder hasn't put their own money in their own company, walk away. And founders, I will tell you that if you have not put your own money into your own company, you should rethink the operation, because angels, as you've just heard, are not going to invest in companies where you don't have a significant interest. But after that, after those founders have exhausted their cash, typically the first round of outside other people's money is what we these days call a hustle round, or historically of friends and family, fools and fans, people who are not investing necessarily because they're doing a detailed financial economic analysis of the company, but they're doing it because they either love the idea, or they love the founder, or they want to help, right? And typically you're raising in here for this very first round under $500,000. And it will typically be done on a safe note and the like. After that, if the company has taken that money and really made something out of itself, and it's got some traction, and it's got some really potential valuation out there, then you get to the pre-seed round, right? And the pre-seed round, this is what used to be called an angel round. It's where angels are typically coming in for the first time, where a third party objectively can come in and make an analysis. And here, with this pre-seed round, you're raising $500,000 to $2 million, typically not from one player, but from a bunch of players, a bunch of individual angels, say, 10 angels, or an angel group, or a seed fund coming in here, right? That's putting in and writing checks of 250,000, $500,000 or thereabouts. And again, in each of these cases, they're getting between 10 and 20% of the company is fully diluted at that point. So that's what you're giving up as a founder, and that's what you're getting as an investor each time. And if the company has continued to make effort and grow and looks like it's really exciting, next comes what these days is called a seed round. It used to be called a lot higher than that. But a seed round is where you have professional investors coming in. And this is typically where you'll get venture funds, you'll get seed funds coming in, you'll get deep-pocketed players who actually know what they're doing, and they'll be investing millions of dollars. So you're talking about a typical $2 to $5 million investment. And again, for a 10, 20, 25% dilution. And after that is finally when you get to the professionals, the VCs coming in, the traditional VCs, not the pre-seed seed round folks, those Series A investors, as we call them, a Series A convertible preferred stock that they're investing in. They're putting in typically, 5, 6 million more, 10 million 20 million conceivably for a Series A, and they're typically getting their 20% dilution. So you can see if you do each of these rounds, getting 20% diluted each time, that's how founders end up with a smaller piece of the company. And so, as Jason Lemkin likes to point out, if you can skip around, that's where the big money is made. So the question is, if that's what these rounds look like, what is and that's how much you're raising, what does the valuation look like at each of these rounds? And we hear so many things in the press and on blogs and on headlines and TV shows about, oh, back of a napkin, they raised at $1 billion valuation. Don't believe the hype, right? These are the actual numbers from the Angel Capital Association from year before last, which shows seed round valuations, right? Remember, this is not the pre-seed or the hustle. This is where angels are coming in with a company with serious traction and real sales. And as you can see, you're looking at a range here of, here in New York, where Gust is based, you've got, 7.5 million pre-money valuation. But boy, places like Texas, 4 million, and much of the country, 5, 6 million. So that's how you get to those numbers about where the valuations sit, because these are seed rounds, then pre-seed rounds are much lower, maybe at the 2 or 3 million or 4 million raised valuation that I talked about before. So this gives you an idea of the way angels and VCs think about investing. They think about the money in, they think about how long it's going to be in, they think about how much the company it buys them, they think about, therefore, what the valuation of the company is going to be, and ultimately how you play this hand out across not just one company picking it, but across many companies to make up your portfolio is how angel investing gets done. And that's the kind of stuff that we're going to cover in the course. And as Pete mentioned before, we are starting this really cool new program called the Gust Guide Program, which is almost a companion to the book, Angel Investing. It'll be a 3-week intensive with me where, starting in early June, we're going to go over all these things. We're going to go over the kind of stuff we just went through, but in more detail, and looking at how you value companies and how you do your due diligence and how you build your deal flow and how you add value and so on and so forth. So that's what we're doing. That's the basic introduction to angel economics and an introduction to the program we'll be doing at Gust Guide. And I'd be happy to take some questions now if anybody wants to ask some questions.